Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, but today is a special request from one of our listeners. This is Winnebago Industries, ticker WGO. If you'd like to get a special request video for a stock that you like, hit it up in the comments below. Don't forget to like this video and subscribe, but this one is from one of our listeners. So we are going to work through my thoughts on the valuation of the company and its business quality over the next few minutes. This market cap is 1.6 billion, EV of 2 billion. You can see that there's some leverage there of about $400 million of net debt, working in the automobile industry. So the Winnebago Industries, I think this is RVs, and so they manufacture, sell RVs and marine products primarily for use in leisure and travel outdoor. They have Grand Design, Winnebago Motorhomes, Newer Motorhomes, Chris Craft Marine, specialty vehicles. So it gives you some idea of what they are. Provides towable products that are non-motorized vehicles. That helps you give you some idea. Motor homes, and let's see if we have some stuff in the marine. I can't see it here, but I'm sure it's here. Recreational powerboat industry under the Chris Craft and Barletta brand name. So they do have some other things, but basically these are recreational vehicles, that level of industry. Now they have a very high share turnover, so certainly not an undiscovered company, relatively high beta. So it suggests maybe there's some volatility here. Those are signs I don't like to see in high quality companies, especially for one of this size. That's actually a very high share turnover number. Return on invested capital. Now, this is actually interesting. If you look over the last 20 years, you see 1 year of losses, but 19 years of profitability. I like to see that. 2009 was a really bad recession, so to see something like recreational vehicles losing money during that time period isn't surprising. You barely made money in 2008, lost money in 2009, but otherwise you've had pretty good returns over that period. You had a recession in 2020. They still managed to make money in 2020, but otherwise, again, 19 years of profitability out of 20, that's a very good sign for a high-quality company. Now, what I don't like to see is it's not super stable. You are jumping around, so that's probably due to leverage in the business, due to maybe a lot of operational leverage would indicate this. Also, you've had some decline basically in your return on invested capital over the last decade. So in 2012, you're at 35%. You dropped down to 18% in 2021. Even if you take 2013's number of a 20%, you've seen a pretty steady decline in the return on invested capital over time. I don't really know what's going on there, but that's not what I like to see. Now, all that said is these numbers are still really good. I mean, you have relatively few years that are below 10%. So there's only 1 year in the last decade that has a single-digit return on invested capital. You had 2 years in the previous decade with single-digit returns on capital, and that was 2008, 2009. So for the most part, if you're not in a recession, this company's earning really, really good returns. You love to see that in a company. So suggesting it's relatively high quality, but it does have some cyclicality. You get these return on invested capital, 18%, return on equity, 20%. You want these numbers above 15. You want this number above 10. Check, check, hitting the boxes for a high quality company. Now, what gets really interesting is when we take everything I've said there about that potential high quality company and you look at a PE of 4.7. This is incredibly cheap. Incredibly cheap. EV to EBITDA 3.7, EV to EBIT 4. EV to free cash flow, so maybe they're not earning a lot of their money in cash. That's a little bit of a sign of maybe something there that you would want to know. But price to sales of 0.4. I mean, this looks like an extremely cheap company, especially when you see revenue growing at 22%, EPS growing at 35%. These are amazing numbers. Now, what this does explain is the fact that your revenue is growing slower than your assets. It explains why you're decreasing return on invested capital over time. As long as you stay above 10%, you're in that 13% range, I feel good about that. But the more you do that, the worse your returns are going to get. So the future is less likely to be like the past because they're not able to have that same level of return. Now, 35% EPS growth over a decade is amazing. Now, what I can see when I work down here is that there's a lot of volatility here. So here's that cyclicality. So you have $1.54 in EPS in 2012. You drop in 2013. You go up in 2014. You drop in 2015. So how many years, of course, across this decade did the earnings go down from the previous year? I see 1, 2, 3. So 3 out of 10 years, you have earnings go down. I'd really like to see the earnings per share go up every year. That's the ideal. And you're seeing that the earnings per share does go down even in non-recessionary years. 2020 was a recession, but 2 years of 2013 and 2015, you still had decreases in EPS. So that's a little bit of a concern. Also, despite growing your EPS relatively high from $1.54 to $8.28. You've not grown your dividend much from going from 36 cents to 48 cents. So why is that? I'm wondering, is this a signal that EPS is basically over earning because you only had $1.84 in 2012, you had $3.52, you're probably over earning with $8.25. So that's my thought here, is that maybe $8.25 is more than you can expect in terms of earnings. You had stimulus, you had all sorts of stuff where people had more liquidity last year due to those stimulus packages. So maybe if you use 352 as this true earnings power, that might give you a better look at this company. So if we do that, $3.52, $50, you're talking maybe, what's that, 15, PE of 15 instead of PE of 4.7. Okay, so, that's a little closer, maybe PE of 14, something in that range. So it's not as undervalued as a PE of 4.7 would suggest. If they can compound and only grow from here, if $8.28 is the low of the next 10 years, this is going to be an amazing investment. But I have my doubts. You have a massive jump in your revenue, 50% jump, 54% jump in revenue year over year. That's just not sustainable. That's not something this company's done over time. They have a lot of volatility. I'd expect that to come back down. So I'd also expect earnings to come back down, which means we really can't trust this PE. However, these growth rates are amazing if they can be sustained over the course of the next decade, and you can start getting to that $20 and $30 per share range. This prices are going to look cheap. So you really need to understand what is the earnings potential of this company, because that's going to drive the effectiveness of our earnings per share. So if you're enjoying this video so far, please hit that like button. Don't forget to subscribe and ring the bell, because by doing so, you help me to grow the channel. Your likes and your subscribes are what tells YouTube that these videos are good, that this channel deserves more viewers. So if you do like this video, please hit that like button each and every time. I really appreciate it. So income statement. You can see one of the big drivers here is that your revenue has gone up 6x, but your gross profit has gone up 12x. You see this $44 million in gross profit goes to $313 million in 2020, $650 in 2021. This is huge numbers of gross profit, basically 20x your gross profit to the trailing 12-month period, which has allowed you to 40x your operating profit, 50x your operating profit from 10 million to 500 million. And so this is the big story of this business. Now, what this is telling me is that this is not replicable again. You're not going to be able to do this again because the business is so much bigger. So you're not going to go from 500 million and 50x it again and be at, what is 50x of 500 million? 25 billion. This isn't going to be a $25 billion operating profit. You're not going to grow as fast. It just simply not plausible. The total addressable market doesn't allow that. Now, what is interesting here is your shares outstanding has gone up over time. So they are diluting you. That's something to be aware of. One thing you'd want to pay attention to is if the capital allocation will change at some point. Will they go from dilution to buybacks? That could be a really positive sign, because at some point their cash flow is just going to not be able to be reinvested back into this company. You see they've 10x their property, plant, and equipment. Again, when you're growing that fast, you just have to keep doing that. They do have an acquisition in 2017 that kind of boosted that growth. You can see a really big jump in the assets from those intangibles that they gained during that portion. What I want to see is, did that income statement see a similar rise? You do see a big jump here. So those acquisitions made a difference in growing their income. If we go to cash flow statement, relatively low stock-based compensation, 2, 3, 6 million. And they do have some buybacks that are trying to offset that. But you can see that all this money that they've spent on buybacks has basically gone down the drain, because dilution would have been even worse. They've not actually reduced the share count. So this stock-based compensation number is understating the amount of stock-based compensation, because they're spending 3 to 4 or 5x more than that on buybacks, and they're not actually buying back enough stock to stop that. So something to be aware of when you're thinking about this company. Again, you have 10 straight years of positive cash flow from operations. That's a good sign. You like to see that. So I'm impressed with this company. This company is really interesting. What's really good about this company is it's probably a company that is cyclical enough that I'm not going to be interested in holding it as much for the long term, because I don't really like that you lose money like this, massive amounts of money during recessions. I also really struggle to understand how to predict a company with this many earnings declines. 3 out of 10 is a little high. But you have the numbers here for really strong compounders. So you need to understand what is their total addressable market, how big can they grow, how fast can they keep growing like this. And you could be set up for a really strong thing. But you need to understand this PE ratio is not reflective of what the price really is. And your low margins are what's driving these massive operating leverage in the business. And so any little thing, any little decrease in demand destroys the profitability of the company. And that really works both ways. I don't know if this would hit on my watch list. For me, it's probably a pass because I don't like companies that lose money like this in recessions. But what I think this company is really interesting for is if you're someone that likes to pick stocks during recessions that have a big potential growth in price, then this might be a company that could be really interesting, because when you see the difference between $1.84 to $8.28, you 350% gain in EPS year over year. That's the sort of thing that could drive massive stock price improvement basically coming out of a recession. So it's the type of company where if you buy this, after it's bottoming in a recession, as with the outlook that it's going to get better and better coming out of the recession, then that could be really attractive if you're into timing stocks. But for me, I'm not into timing stocks. And so despite this compounding really fast, I would find it hard to predict. And so for me, it won't go on my watch list, but there could be a niche there that makes it really interesting for some listeners. If you've enjoyed this, please hit that like button. Please subscribe and ring the bell so you can get notifications as I upload new videos each and every week. Thank you for listening. And until next time, stop paying fees, start building wealth.